Assalamu alaikum, folks. I hope you are doing well. Today is Tuesday, March 18th, and the market has pulled back once again. If you look at the indices, they're all in the red. And you know what I like to do on days like today? I like to take advantage of the opportunities that the market is making available. And in this live, I will be going over one such opportunity and going over the valuation and my share price targets for that particular stock. If you enjoy these lives, do make sure to leave a like and become a PIF member if you haven't already. Seats are limited, 35% off. Use code Ramadan 2025. I'll show you it in a second. Everything's in the description if you're interested in becoming a member. Now, before I get started, my heart goes out, my prayers go out to our brothers and sisters in Gaza who have been enduring something that no one has endured, really, the barbarity of the Zionist regime is something that I'm not really sure history has ever seen before. And this is obviously something that is directly correlated with the amount of cowardice that a particular people have. So, barbarity always increases with the amount of cowardice. So, whenever you see someone who's really acts tough when dealing with an opponent that they know cannot really fight back, that person is a very weak coward. And so this is the actions of the Zionist regime are very befitting of what we know about them to be true. Now, it is in terms of what can Muslims do, the number one thing that Muslims can do, beyond talking about it, obviously talking about it is very important, and this is why Zionists will try to shut down any voice that exposes their criminality. But and obviously, wherever possible, if you're able to help out someone who has been impacted, you should do that. But the number one priority is to get rid of the quote unquote governments of Muslim countries that are complicit with the Zionist regime, that protect its borders, that provide aid, provide supplies for them. You know who I'm talking about. So, the number one priority for Muslims is to get rid of these governments, to free themselves of these governments. Alhamdulillah, this has happened in Syria. Syria is now free, and I think that within 5 years, it will probably be able to defend itself effectively, and probably within 10 years, it will be able to defeat Israel on its own. But we need to expedite that timeline so that our Palestinian brothers and sisters don't have to endure another 10 years of this. And to expedite this timeline, we need to get rid of these governments that are protecting the borders of Israel. That's the only solution, folks. You can. Israel is not the direct problem. The actual problem are these governments. Get rid of them and free the Muslim people, and Israel will solve itself. That's a solved problem in my book. All right, guys. Salam, everyone. Salam, Rashad. Nice to see you. Thanks for moderating. Nice to see you, Osman. Let's go over the stock of the day, which is LifeMD. Now, I've spoken about HIMS before on this channel, and kind of the vibes were off for me for HIMS. Not as a business. I think the business is a good business, and so I was kind of looking for a reason to sell my position in HIMS when I sold it, and when I heard Amazon was getting in that business, I was like, okay. Maybe this is going to slow down the growth that they've seen, and therefore adjust the forecast for this company. and adjust the valuations. Um, so far, that hasn't happened. Hims has been chugging along quite nicely. It's a very well managed company, and um, it's expanding the opportunities that it has available for it. And so I think it's going to do well. However, they have a distinct sort of flavor to their marketing that kind of rubs me the wrong way. And so whenever anything rubs me the wrong way, I just don't take a don't take a risk on it. There are enough fish in the sea, as they say. I would say LifeMD is one of those fish that are in the sea that is in the telehealth business, and I think has a very attractive valuation. Let's look at what I'm talking about in more detail. Before I get started, this is, by the way, so I'm consistent here with the format. This is what the market was doing today. You can see right across the board. Yesterday was, Mag 7 basically was red. Everything else was green. Well, today, basically almost everything is red. Now, let's talk about LifeMD. So they're building they say the leading platform for comprehensive virtual healthcare. It's good that they have that ambition because it tells you just how big the market is. Uh, they, if you look at the numbers, they're quite impressive. So 1.1 million virtual consults conducted. So basically, they're in the telehealth business, right? Providing uh, medical services online, and I do believe that the future of healthcare is going to be online. It's going to be convenient. It's going to be personalized, and it's going to be more cost effective than it is today. They have 275,000 patients, and their guidance for 2025 is between 265 and 275 million. I use the 270 million uh, mark just so mid guidance in my valuation. I'll show you in a second. 300 employees. They have end-to-end compliance-first platform for direct-to-consumer virtual primary care, early mover advantage. I'm not sure. I would ignore that. I don't think that really matters at this point. What they do have, though, is affiliated 50-state medical group anchored by full-time providers. So I think herein lies, building a moat for telehealth providers is in the networks that they make themselves a part of. That's how you gain gain a moat for your business. They have flexible and proprietary technology stack. I'm going to really discount that. I mean, I think the technology is a solved problem. I don't think the technology is necessarily something that you can bank on that's going to defend the business. They also have this weird sort of 73% equity holder in Work Simply, which is a SaaS business in the document management space. So why they have that, there's a story behind it, but essentially it has nothing to do with their telehealth business. So I mean, I think if they can, it's a good cash provider for the company, and it's profitable business. It provides a good amount of cash for them, so I can see why they're holding on to it. But just for the sake of focusing everything on telehealth, I would be a fan of them selling Work Simply. And I actually think that part of the reason the valuation for this company may be attractive is because it has Work Simply, which isn't growing as fast as their telehealth business. And therefore, when you're looking at top line, for example, you may see it, the number is not growing as fast as the telehealth business on itself is growing. And therefore, the valuation is being built on that growth rate that is being tempered by this Work Simply business. So if they were to sell this business, I believe their comps would be better, quarter over quarter, year over year, and therefore their true growth would be reflected in the valuations that a lot of people are giving it, and it would perhaps support a greater market cap. So in terms of the size of the opportunity here, it is quite large. So we're talking about 170 billion total addressable market in the US. And this includes the things that LifeMD is going after. male and female sexual health, weight management, diabetes, cardiovascular, dermatology, hormone therapy, integrative health and wellness, and insomnia. And there, you can imagine that this list would grow and grow as they get more of these disciplines under their belt and they get more familiar with and get more good at delivering these services to their customer base. The opportunity here is really endless. And if you look at their growth here, you can see that it has been quite impressive. So if you go back to 2019, their revenue was 13 million. 11 million coming from telehealth, 2 million coming from Work Simply. Fast forward, 6 years, um, and they are earning. They earned actually in 2024. They earned, or revenue rather, it was 212 million, 54 million from Work Simply, 158 from their telehealth business. They're forecasting going from 212 million in top line to 270 million in top line. And if you can see the Work Simply revenue, it just goes from 54 to 60. But the telehealth revenue goes from 158 to 210. So the telehealth business is growing faster than the Work Simply business. And therefore, I believe that if they were just to sell the Work Simply and focus on telehealth, then their comps would be better, their growth rate would be better, and they could use that money to invest in the company, the proceeds from the Work Simply sale. So they're forecasting close to 30% growth in 2025 versus 2024. And 1.1 million patients and customers to date. That number should increase as well. Now, something that I always tell you guys is there are easy ways to make money and there are hard ways to make money. And that reflects itself in the margins for the company. So if you look at the margins, especially the gross margin for this company, you see the potential. So on the left here, you see the telehealth gross margin. It's going from mid 70s. Now we're in the upper 80s. We're close to 90% for the gross margin. So every dollar, because delivering these telehealth services, the cost of goods sold is very low. And what's good is that you really have a strong economies of scale contribution to your gross margins. The bigger you get, the easier it is to the incremental cost for every additional patient is really very low in terms of variable costs, very high in terms of fixed costs. And so the margin becomes better and better the more the business expands. So this is a good, I think, business to be in if you're able to make it work. All right, so this is the code I mentioned, guys. Ramadan 2025 for 35% off. Limited spots are available. Use it while still valid. Now let's go to the LifeMD valuation. And looking at, these are some of the numbers that I mentioned. I won't go over all of them. Gross margin 2024, 88.7%. They have 35 million in cash on hand. Shares outstanding, 44.5 million. Now, if you look at their operating cash flow, so what we want to do is perform a discounted cash flow analysis as usual. So if we try and figure out their free cash flow from operating cash flow and subtract the capex, the capital expenditures, that comes to 5.4 million. So the free cash flow margin, if we're comparing it to revenue, is 2.5%. Now, I'm assuming that this free cash flow margin is going to improve with economies of scale. So I think that it can go much higher than where it is right now. So 2.5% can become 4% in 2025, 6% in 2026, and maybe stabilize at 8% as their offerings and business matures. keep in mind, this is a young company. So in 2024, you can see here and for 2025, I just went with what the business was guiding, which was 270 million. And then 2026, you can see the growth rate using 25% growth rate. So I'm assuming the growth rate is going down. Although I think that they could sustain, 30% growth rates for many years to come, considering the total addressable market that we talked about. This is a really tiny business. We're talking about 270 million expected in 2025 compared to the size of the market, the opportunity, as we saw, close to 200 billion, and probably growing as well. So if you look at the year-over-year growth, I think I sandbagged these numbers enough. So 25% the year after in 2026, 20% in 2027, 2028 is 15%, 2029 is 15% as well. And then the free cash flow margin, I went over that. So pre-tax, you can see how much money they are making in terms of free cash flow, and then post-tax, I assumed tax rate of 25%. So if we were to use the weighted average cost of capitals to discount these cash flows, so I'm going to discount these numbers over here. If we were going to use an 8% discount rate, and figure out how much these cash flows add up to, that comes out to 84 million. And then if we use a terminal growth rate of 5%, which I think is very reasonable, the terminal value, you don't have to memorize this formula, but the terminal value ends up coming out to 1.1 billion, but you discount it 5 years, since that's when the 1.1 billion would be achieved, and that comes out to 760 million. Now, if you add the 84 million that we calculated, which was the cash flows from the next 5 years, you get to a market cap of 845 million. Divide that by the number of shares that we have right now, and you come out with a stock price of $18. Now, if we are to look at LifeMD and what it's trading at right now, LifeMD is trading at $5.65. Now, I don't like to go with, the bull case. Obviously, I like to, sandbag even further, and perhaps the 8% weighted average cost of capital was too much. So let me see. So market capitalization is 250 million at today's price. So what we're going to do is we're going to assume different weighted average cost of capital. So if I go to 10% weighted average cost of capital, the target share price is $11. If I go to 12%, I don't think that's necessarily fair for the company. I think it's going to be around 10% actually, considering this. I mean, they've de-risked their business a lot. Maybe if you asked me, 5 years ago, yeah, 12% would be appropriate. But now I think they have enough momentum. They're actually going to be. They posted a profit last quarter, and they should post a profit in 2025. So I think a lot of the risk in the company has been taken out. But if you were to look at the weighted average cost of capital at 12%, then the share price would be 641, still above today's price of 565, but not as generous of an upside. So I think going with the 10%, so the mid-range there, weighted average cost of capital, seems reasonable. All of my other assumptions, I think, seem very reasonable. Now, when I'm setting the take profits price, I like to have a cushion there. So, probably won't be at 11, 13, maybe a little less than that. That being said, I think there's ample room for growth here. And I think that, 100% return on this company in the next 12, 18 months is not far-fetched. So in these times where, obviously not financial advice, be sure to do your own due diligence. I hope I'm just providing something that's food for thought for you that you can, take a look at and let me know if you think I got any of my numbers wrong. But considering the S&P, as I said yesterday, was averaging 5% annually over since 2000, and gold was averaging 10%. If you're able to do something like this and double your money in 12 to 16 months, I think that's a pretty good opportunity. Now, to see list of our full watch list, what we like to keep an eye on and what we like to snipe when the opportunity is right, make sure to become a PIF member. With that being said, let's go to some questions. Um, Fatin says, should we invest in the S&P? Well, there are some companies in the S&P that I wouldn't be comfortable investing in from a halal perspective. So I would probably, I think one idea is to invest in the sort of halal version of the S&P, and that would be kind of a set it and forget it type deal. And if you do that, so I don't want to hate on investing in the S&P. I think investing in the S&P will do better than most stock pickers do. Certainly, there will be a lot less volatility. The S&P is down 10%, but a lot of these names are down 50%, 50 to 80 to 90% sometimes. So the cost of higher returns is greater volatility. So if you can't stomach the volatility, I would definitely go with something like the S&P, but a halal version of it. Thanks, Rashad. Um, I really appreciate it. Really appreciate your moderation as well. Yeah, keep the people in Palestine in your prayers, inshallah. TMDX, that's actually Muhammad Saad is asking about TMDX and whether it's halal or not. I think it's fine. Um, I think it's fine, brother. The only thing that, let me check for you 1 second on our site. Yeah, it's comfortable on our site. So I think one thing to look at is sorry. Yeah, one thing to look at is the interest expense and the amount of debt that they have, if it's going in the right direction or not, and what you forecast, for the next year that to be. But I have heard some good things about it. It has been a stock that's on my radar. Perhaps I'll do a deep dive into it, inshallah. All right. With that being said, make sure to leave a like. Take advantage of these last days of Ramadan. It's we've gone through 2/3 of the day already almost. So make sure to take advantage of the remaining days. Until next time, make sure to take care of yourself. Assalamu alaikum and peace be upon you all.